Hello and welcome to this webinar on planning a tax-healthy new year, hosted by myself, Marcia Banner, and my colleague, Niki Patel. Over the next 30 to 45 minutes, we'll be looking at ways in which you can structure your affairs for a tax-efficient outcome, both in the run-up to the tax year end and going forward. There will be an opportunity for questions at the end of the webinar, but you should bear in mind that neither myself nor Niki are able to provide investment advice. So any investment queries will need to be directed to your St James's Place partner. Also bear in mind that any guidance we provide on tax matters is generic and should therefore be confirmed with your own independent tax advisor to ensure that it's relevant to you personally, taking account of the entirety of your specific circumstances. So the crucial principle overriding everything that we're going to talk about today is that if your financial plan is in good tax health, you will have a far better chance of achieving your financial objectives than if it isn't. And of course, one of the key components of a successful financial plan is informed financial advice. Advice which is tailored to your specific circumstances with a view to helping you achieve your overall aims and objectives in a tax-efficient way. And this is something that your St James's Place partner can help you with, as we'll see later. So is tax planning simply about making sure that you do what you can to use allowances as the end of the tax year approaches? In other words, is it just about last minute planning? Well, to some extent, yes, because we're all prone to leaving things to the last minute, especially when schedules are busy. But the most effective tax planning is done thoughtfully in advance so that the tax year end is not only about using the allowances and reliefs that might otherwise be lost, but it's also about planning ahead for the full tax year to come and, where possible, looking even further ahead so that you can be confident that you've arranged your affairs and investments in a way that will ultimately facilitate tax-efficient realisation and transfer of those investments when your thoughts ultimately turn to inheritance tax mitigation, as they inevitably will. Now, when you set to thinking about your tax health, and in particular when you're planning for the year end and the year ahead, it's impossible to make tax-conscious decisions without giving some thought to the current tax context. This year, and in the last few weeks in particular, there's been intense focus in the media on tax and tax policy, and it's been difficult to keep up with which changes are now going ahead, which have been reversed, and which allowances have been frozen and until when. I'm therefore now going to hand over to Niki, who will talk you through where we are now in terms of the main taxes, income tax, capital gains tax and inheritance tax, following the recent autumn statement. Over to you, Niki.
Thank you, Marcia. So what have we seen? Well, as Marcia said, we've had a few changes that were announced, we've had a few U-turns, etc. So here, what we've basically got is where we are today. So in the current tax year, this slide just sets out how much an individual can have income of whereby they've got no income tax to pay. Your income that is subject to tax covers most sources of income, okay? So that could be things like salary, profits from a partnership or sole trade profits, pension income, rental income, etc. However, there are some sources of income that are fully exempt from tax. So if you've got savings in something like an individual savings account, then that income would be tax-free, as well as some investment income, commonly VCT dividends. Now, what we did originally see was that there was going to be abolishment of the 45% rate of tax. And this is where individuals earning over 150,000 would ordinarily be taxed at 45%. However, we saw a very, very rapid U-turn on that figure. And in the latest autumn statement, instead what we saw was a reduction of that additional rate band. And what that means in turn is that anybody earning in the next tax year more than £125,140 will now be taxed at 45%. The effect of this is that actually somebody earning 150,000 in the current tax year compared with somebody earning exactly the same amount in the next tax year, they're actually just around £1,243 better off in this current tax year than they would be in the tax year that follows. So, of course, what has happened with these changes is because thresholds, and this is whereby individuals pay either 20%, 40% or zero tax, as well as the 45%, because these amounts have effectively been frozen and we've seen this reduction, more and more people are going to find themselves paying tax where they might not otherwise have done so. So there are obviously, some planning opportunities, which I will come on to talk about. Let's also look at what happened with the dividend allowance. Now, the dividend allowance is specifically available against dividend income. So ignoring your ISA dividends, if you've got, for example, shares that are paying dividends or unit trust investments, there is an allowance that everyone is entitled to in the current tax year of £2,000. And what was announced in the autumn statement is that that allowance is going to reduce next year to £1,000 and then further reduce in the 2024-2025 tax year to just £500. So those of you planning at the moment before we hit April, ideally it is advisable to obviously make use of this allowance where it currently stands at £2,000 before we see a reduction in the next tax year. And a lot of that will be looking at your investment portfolios to see where this could or could not be maximised. Let's move on and have a look at the rates, because something that should not be forgotten, of course, is that the rates at which we pay income tax, so that was the slide we saw earlier, whereby you're either paying at 0, 20%, 40% or 45%, what we mustn't forget is that at least with the dividend rates that are applicable to dividend income are, of course, lower. And what we've seen, again, there was talk about reducing for the next tax year, or remaining, should I say, at the rates that we had previously. However, these rates are now being set and ultimately are set out here. So effectively, the rates applicable are 8.25% for those at basic rate, 33.75% for higher rate taxpayers, and 39.35% for your additional rate taxpayers. What we will see, however, from next year is that 39.35% will kick in once somebody's got dividend income of £125,140 or more. So that is something to bear in mind. In terms of planning in this area then, and things to talk to your advisor about, is obviously when you're looking at your income and your portfolios, is maximising use of the available personal allowances. Now, the personal allowance is usually offset, as I mentioned, against your salary. It can be against pension income, rental income, etc. But in addition to that, we have some allowances that apply to certain types of income. So if somebody, so a basic rate taxpayer having some interest income is entitled to what's known as a personal savings allowance, and that is currently set at £1,000. For a higher rate taxpayer, that's reduced to £500. And for an additional rate taxpayer, unfortunately, they don't actually benefit from a personal savings allowance. It's very, very important to bear in mind, however, that allowance only applies to interest income, so bank account interest, or if you've got unit trust portfolios generating your interest, then those sources of income. You've then got something called a starting rate band, which again only applies to interest income. And there is a quirky rule as to whether or not an individual would benefit from that. So again, advice will be essential. and the dividend allowance, as I've just mentioned. Now, remember that married couples or those in civil partnerships, they've got more scope to use allowances between them, primarily because you can transfer assets, investments to each other, and then those certain investments that may be generating income can then be taxed on a couple that may be a lower rate tax-paying spouse or civil partner. In addition, if you've got an individual who earns less than their current personal allowance, which is the $12,570 that I mentioned, there is scope for that person, if they're earning, say, around £10,000, to actually transfer up to 10% of their personal allowance to their spouse or civil partner and maximise the personal allowance that they may not otherwise be using against their income. They transfer it to their spouse or civil partner and they can use it against their income. The only thing to bear in mind is that the person that they're transferring it to also needs to be a basic rate taxpayer. There is, when I talked about the sources of income and I mentioned exempt income, obviously for all clients, something to think about is maximising things like your ISA allowances. This enables you to build a fund that can be very, very readily accessible, completely tax-free. And the current subscription limit into an ISA is £20,000. And then there are some other investments where you might want to seek advice, because you can invest in something known as a venture capital trust, whereby the dividend income is completely tax-free. There is also scope when you're looking at your income tax planning, whereby depending on the liability that you may have, you can invest in investments that benefit from something known as tax relief, and that's restricted to 30%. And the effect of these types of investments is primarily that by making that investment, you reduce your resulting income tax liability by 30%. Again, these are deemed to be higher risk investments, so advice will be essential to determine whether or not these types of investments meet not only your risk profile, but are in line with your overall objectives. Something to bear in mind, and I'm going to come on and look at an example, is that if you've got income that is in excess of 100,000, the personal allowance, the 12,570, is reduced by £1 for every £2 over £100,000. So let's have a look at the effect of that. So what happens is that the rate of income tax that you would pay because of this gradual reduction of your personal allowance of 12,570, because that is tapered by £1 for every £2 over the 100,000, what we effectively find is that somebody earning up to £125,140 will fully lose their personal allowance. So if you've got somebody that is affected by this, essentially what this means is that they end up paying an effective rate of up to 60% of tax. And that is by loss of the personal allowance, the 20%, and also more of their income being taxed at the higher rate at 40%. However, there is a lot of scope for planning, and advice will be essential. But one of the main areas in relation to this is pension contributions. So essentially, if somebody chooses to pay into a pension, they can reduce that 100,000 limit by the amount of that pension contribution. And effectively, by doing so, it means that they can almost re-benefit from their personal allowance, that 12,570 again. So they make that gross pension contribution. It comes off of what is known as the adjusted net income of 100,000. So, for example, if you had somebody earning 120, they paid 20,000 into their pension, where we make that adjusted net income figure, instead of being 120, it goes back down to 100, and they fully benefit from that 12,570. So without getting too technical, because I can appreciate that that might be quite a bit to take in, if you are in a situation where your income is on the cusp of this, it is definitely worth speaking to your advisor to see what planning opportunities you could carry out in order to reduce that income figure to benefit from that personal allowance. And as I said, pension contributions, and also the other one to think about is gifting to charity. Let's move on then to have a look at capital gains tax. So what happened in the autumn statement, if anything, in relation to capital gains tax? Well, what we saw was that the annual exemption, so this again, very similar to the personal allowance, whereby individuals can earn up to a certain amount without needing to pay tax. Very similar with regards to gains. Individuals have got something what's known as an annual exemption available to them, and that is currently set at 12,300. And what that effectively means is that if you sold some shares, you could benefit from gains up to that limit without having to pay capital gains tax. And what we saw in the autumn statement is that allowance is going to be reduced to £6,000 in the next tax year, and further reduced to £3,000 in 2024-2025. Something to bear in mind that the rate at which an individual would pay capital gains tax depends very much on their other taxable income. So effectively, if the gain falls within the basic rate band, then they will pay tax at 10%. If the gain is attributable to residential property, the rate is increased to 18%. For higher rate taxpayers, the rate is 20%. And again, if the gain is attributable to residential property, that again is increased to 28%. There is, as you will again appreciate, quite a lot of planning that can be carried out in relation to capital gains tax. The annual exempt amount, the 12,300, if it's not used in any current tax year, it is unfortunately lost. So it does make good tax planning sense to look at investment portfolios and determine whether or not there is some scope to use that allowance. In the current tax year, using that allowance would save a high rate taxpayer up to around £2,460. Whereas in the next tax year, when we're going to see a drop in that allowance to 6,000, that will only save them around 1,200 if they're using that allowance. And for a basic rate taxpayer, the tax saving in using the allowance is worth up to around £1,230 in the current tax year, and that will reduce to £600 in the next tax year. So it is important to consider whether or not the allowance can be used. And given that we're in December, heading towards the end of the tax year, using the 12,300 in this current tax year will, of course, afford some tax savings. And again, with couples and civil partners, remember that there's more scope to use allowances between them. It's possible, again, for couples to transfer shares to one another. And what effectively happens is ordinarily, even though that transfer is taking place, the recipient spouse or civil partner would take on the cost from the donor spouse, so the person giving it to them. So effectively, there's no CGT to pay on that immediate transfer. And then when the individual decides to sell those shares, they, of course, can use their exemption against the capital gain. So there is that planning as well. What about losses? Something to bear in mind with losses is that if there are losses that are made in the current tax year, they do need to be offset against gains as well that have been made in the current tax year before an individual can use that annual exempt amount. So that amount of that 12,300 reducing to 6,000 next year. However, if you've got losses, so historical losses, these can, of course, be carried forward indefinitely. That's not magic. So one thing to bear in mind, you do need to notify HMRC about those losses. And that can either be done via your self-assessment tax return, or if you're not ordinarily in the scope of completing one, by writing to HMRC. And you have got up to 4 years from the end of the tax year in which to make that claim. So if you have sold assets that were standing at a loss historically, there might be some scope to notify HMRC, if you haven't done so already, about those losses, so that you've got them available to offset against future gains, especially where we're going to see this reduction in the annual exempt amount in going forward in the next couple of tax years. There is some planning opportunities as well, with otherwise known as bed and ISA or bed and spouse. So unfortunately, when you're looking at using your CGT annual exemption, because of some quirky rules, it's not possible to simply sell an investment or some shares or units in a unit trust and repurchase those same shares or units immediately. These are known as the so-called bed and breakfasting rules, and your advisor will be able to talk to you about them in a bit more detail. But because of these rules, you can't just simply reacquire an investment. However, it is possible to sell some shares and then buy back those shares in an ISA wrapper, so in an individual savings account, stocks and shares wrapper. So that is viable planning. If you've got some shares standing at a gain, that's an option. Or alternatively, you could have one spouse or civil partner sell some shares, and then the other one can separately buy those shares back. So again, some planning which avoids what's known as these so-called bed and breakfasting rules. Some other opportunities are, again, making pension contributions. So as I mentioned, that the rate at which you pay capital gains tax very, very much does, of course, depend on what other income an individual has got. So basically, what they can do is, if they make a pension contribution, there's opportunity for planning whereby they can ensure that their income all falls within, for example, the basic rate tax bracket. And equally, what that means is, if they've done that type of planning, then any taxable capital gains that they've got will also suffer CGT at the rate of 10% as opposed to 20%. So by taking this action, you can also save yourself some capital gains tax. So again, it's another area to speak to your advisor about, especially whereby you have made some capital gains that might otherwise be taxable, and you haven't necessarily maximised the pension opportunities available to yourself. What about with inheritance tax? Did we or did we not see any changes announced in the autumn statement? So what we've seen, and this has actually been going on for a while now. So every individual, or should I say UK domiciled individuals, are all entitled to a threshold, otherwise known as the nil rate band, at which they can have assets, so property, investment portfolio, shares, etc., at which there's no inheritance tax payable. And that nil rate band is currently set at 325, and that's on an individual basis. So, of course, you can pass assets to your spouse or civil partner, and there are some rules in relation to being able to benefit from what's known as 2 times that allowance on second death, because if everything passes on first death and it passes exempt, then obviously that threshold would not have been used. However, what we've seen since 2009-10 is that threshold has been frozen at 325,000. And at the moment, it was expected that was going to remain frozen for, up until 2025, 2026. And what was announced in the autumn statement was, unfortunately, a further freeze to these allowances. Or to that allowance. So that is going to remain frozen at 325 until at least April 2028. In addition to that, what we saw back in 2017 was an introduction of something known as the residence nil rate band. And this applies where you leave a qualifying share of a property that you've effectively lived in as your main residence to your children or grandchildren. And what is available is something known as this threshold at which you can reduce the amount of tax you would pay against that property interest by your residence nil rate band. Again, there are some rules that if the estate is worth more than 2 million, very similar to the income tax personal allowance, where you taper it down. So we talked about where you reduce the amount available by £1 for every £2 over that 100,000. Here it works very similar with the inheritance tax residence nil rate band, but instead we're looking at £1 for every £2 over the 2 million. And effectively, the residence nil rate band was also to remain frozen till April 2025, 2026. And actually what we've seen is both of these allowances now remain frozen until April 2028. So in turn, what's happened is obviously inheritance tax planning, because of these frozen thresholds, is of course becoming more and more popular. HMRC statistics have actually shown for a few years now that because of rising property prices and also rising increases in investment portfolios, etc., more and more people are finding themselves, or estates, should I say, whereby inheritance tax is now likely to be payable, because obviously when your assets are increasing in value, but these thresholds are frozen, then, in turn, more and more people are being brought into the inheritance tax net. So planning in this area has become very, very popular. And there are, again, very similar with your income tax allowances and your capital gains tax allowances, there are yearly exemptions when it comes to inheritance tax planning that can be used. So, for example, there is something known as the annual exemption, and that is currently set at £3,000. So you can make gifts of up to £3,000 to anyone that you want to without there being any inheritance tax payable. Unlike the CGT exemption, if you haven't used it in the prior tax year, it can be used in the current tax year. However, a quirky rule is that you have to use the current tax year's annual exemption of £3,000 first before you can use the £3,000 from the previous tax year. There's also something known as the small gifts exemption, and here you can make gifts of up to £250 to any number of people in the tax year, and you can do that in each and every tax year. Another exemption is known as the excess income. So effectively, where you have got excess income, so you've kind of looked at your income and expenses for the tax year, and you find yourself in a position whereby your income is way more than your needs of the year, you can make some gifts under this exemption, and they will be covered and be IHT free. However, there are some conditions that need to be satisfied. So again, you would need to seek some advice, but broadly, you need to be making these on a regular basis, and they mustn't impact your usual everyday standard of living. There is opportunity, of course, to make gifts in lifetime, whether outright directly to certain individuals, or trusts can be used. And again, the rules around making these gifts will very much depend on your individual circumstances and what you decide to do. There are other package solutions available, which your SJP partner will be well averse to talk to you about, whereby you can actually carry out inheritance tax planning, even where you might require some access. So there are some products available, they're otherwise known as things like the loan plan, discounted gift plan, whereby your advisor can talk to you about these and see whether or not they meet your overall circumstances and desired objectives. And of course, it is very, very important to always ensure that your wills are drafted not necessarily just tax efficiently, but in line with your desired objectives, outcomes, and also taking account of what the tax effect may or may not be, depending on how that will has been drafted. When I mentioned about the frozen nil rate ban threshold, if you haven't revised your will since that, since the introduction of that, or you're coming into an inheritance or have come into an inheritance shortly, then there's more scope to talk to your advisor about some planning opportunities in relation to that. So, there is a benefit to ensure that what you've got in place currently still meets your desired objectives. And if you've come into an inheritance, do you require it, or is there some planning with regards to that could be carried out so as to not make your own inheritance tax position worse? On that note, I'm going to now pass back to Marcia, who's going to talk you through the corporation tax changes that we saw as a result of the autumn statement.
Thanks, Niki. That's really interesting stuff. So the business owners and property investors among you will also be keen to know where the recent autumn statement leaves us in terms of corporation tax. So corporation tax is currently levied on company profits after expenses at a flat rate of 19%, which is comparatively low as against the rate that would be payable on business profits by a sole trader or partner, or by a property investor on rental profit were the company owned properties owned personally. However, it's now been confirmed once and for all that the rate of corporation tax will rise with effect from 6th of April 2023 to 25% where profits after expenses exceed £250,000 per annum. And the 19% rate that currently applies will only continue to apply in cases where company profits are £50,000 or below. Companies whose profits fall within these upper and lower profit limits will pay corporation tax at the main rate of 25% as reduced by what we call marginal relief. Marginal relief provides a gradual increase in the rate of corporation tax as profits increase until the main rate of 25% is payable across all profit once profits reach that upper profits limit. However, the way in which marginal relief is calculated is quite complicated. And it means that companies with profits between 50,000 and 250,000 could pay an effective rate of tax on their profit of as much as 26.5%. So there are also some tax charges at a shareholder level as well, such as a planned reduction in the dividend allowance, which Niki's touched on, from the current level of £2,000 per annum to £1,000 per annum from April 2023, and further to £500 per annum from April 2024. Also, from 6th of April 2023, which again Niki's mentioned, the threshold for additional rate tax will reduce from £150,000 to £125,140. And that means that the top rate of dividend tax, which will now remain at 39.35%, will be payable by a greater number of business owners who are extracting company profit in the form of dividends. Taking these forthcoming changes into account, year-end tax and financial planning considerations for business owners are likely to be focused on trying to ensure that where profits are likely to exceed the lower profits limit of 50,000, profits are accelerated or advanced so that they're taxable in the financial year 2022 rather than after 1st of April 2023. And where the effective rate of corporation tax after 1st of April 2023 is going to be more than 19% based on anticipated profits, deductible expenditure and pension contributions are postponed to the next financial year when corporation tax rates will be higher, and so the deductions will be worth more. In relation to distributions from the company, Companies that haven't yet paid dividends to shareholders in this tax year may want to review their financial position and consider paying dividends to fully utilise unused dividend allowances of their shareholders before 5th of April 2023. Consideration should be given to the implications of paying extra dividends or bonus in 2022-23 as well, rather than in the next tax year. So that way you can make use of the higher additional tax threshold that's applicable in the current year. And finally, if a spouse of a shareholder has no dividend income, then consideration could also be given to allocating some shares of the company to them. And this will mean that they can also use their dividend allowance before the end of the tax year. The allocation should, of course, be made on a commercially justifiable basis. So, in summary, with the tax year end approaching, it's important to seriously consider all of the possible last-minute and plan-ahead ways to be more tax efficient. And to assist you with this, we would recommend that you contact your St James's Place partner to take a tax health check. This is a check on your tax well-being aimed at identifying what actions could be taken to deliver better tax health in light of your individual circumstances. The tax health check is founded on 11 simple questions and has been developed by St James's Place to help unearth opportunities that could be exploited to achieve improved financial well-being for you, or at the very least provide you with reassurance that your existing financial plan is already in good shape. So thank you for listening, everybody. We're now happy to take questions, which you can submit via the chat facility. And we also have some pre-submitted questions here, which we will try to get through. So just to reiterate, we can't deal with any of the investment type questions. So things like, does Bitcoin have a role to play in effective tax planning, or questions about percentage interest rates and the cost of investing versus returns, those kinds of things, you will need to refer to your financial advisor or St James's Place partner. But I will try and answer some of the tax ones that we haven't answered during the webinar. So one of the questions that we had was whether will trusts are still a viable proposition. So in terms of will trusts, I mean, they used to be a lot more popular than they are now, because now, of course, as Niki mentioned, we have what's called a transferable nil rate band and a transferable residence nil rate band. So it means that a married couple get to benefit from 2 nil rate bands and potentially 2 residence nil rate bands, no matter whether they use a first death will trust or not. However, will trusts do still have their place in lots of different scenarios. For example, there are different types of will trusts as well. So, for example, you might use what we call a life interest trust. So if you have, if you're on a second or subsequent marriage, you have children from a first marriage, and you ultimately want your wealth to go to those children, but in the interim want to make sure that your surviving spouse has security, you can use what's called a life interest trust in your will. And what that does is it gives your surviving spouse security. It means that they have a right to live in your house or your shared house during the rest of their lifetime without having to pay any rent or anything like that to your children. And it means that they get to receive an income from your investments to support their standard of living during their remaining lifetime if they've been predeceased by you. But ultimately, the trust means that you have control over who ultimately gets that capital value. So on the death of that surviving spouse, then your assets will pass to your children from that first marriage, rather than in accordance with the terms of any new will that your surviving spouse may have made. There is also a place for discretionary will trusts in the will, despite the introduction of the transferable nil rate band. So, for example, if you have an estate which is worth more than 2 million, if let's say you're one of a married couple, you're in a married couple, you've got an estate that's worth more than 2 million between you, then if you left everything to your surviving spouse, then on second death, her estate's going to be more than 2 million. And therefore, it means that there's no residence nil rate band available. And actually, if the estate was worth more than, on current values, 2.7 million, it would mean that all residence nil rate band was lost, including any that might not have been used on first death. So in that scenario, by leaving some assets to a will trust on first death means that less is passing to the surviving spouse. You're still using all your your two standard nil rate bands, because your will trust uses one, your surviving spouse still gets the other one. But if you've managed to make sure that not everything is passing outright to your surviving spouse, then what you've done is lowered the estate and made it more likely that residence nil rate band will also be available on second death, therefore making a potentially significant inheritance tax saving. Let's have a look at another question. So, any advice re rental income from two properties between myself and my spouse? Okay, well, the one that so here, the position is that if you own property jointly, then the way it works is that HMRC will automatically treat you as having 50% of that rental income each, regardless of how you might actually own the property. So let's say, for example, you owned a property and one of you owned a 30% share and the other one of you owned a 70% share in it. Then the default position is that HMRC will still treat you as having 50% of the income each. Now, if you don't want to have 50% of the income each, because potentially one of you pays tax at a higher rate than the other, then what you can ask HMRC to do is to tax you in accordance with the percentages of the property that you actually own. And you do this by completing a form called a Form 17, which is available online. Now, the thing with the Form 17 is that it can only be used, one, if you're a married couple, and two, if you actually do own the shares in the property otherwise than by 50%. So if you do currently own as joint tenants, you'll need to change that so that you own on a tenancy in common, and probably execute a declaration of trust to say that one of you owns, let's say, 10% and the other one owns 90%, for argument's sake. And then you can submit your Form 17 to have you taxed as to 10% on the income for the one of you and the 90% on the other one of you. Nikki, do you want to take one?
Yeah, so basically somebody had asked about tax implication for offshore funds. So here it very much depends on what you may or may not have invested in. Okay, so when you're looking at offshore funds, they come into they're categorized as two different types. And technically, the words that HMRC use is something known as your reporting funds or your non-reporting funds. Now, the provider that you're invested with ought to be able to tell you exactly what it is that you've got. But the point is that if you've got reporting funds, then you're taxing as capital gains. So you can use that capital gains tax exemption that I mentioned, that 12,300, against any gains on sale of those funds. And then you'd pay 10% or 20% in terms of whatever is remaining taxable. If you've got non-reporting funds, however, the tax treatment is different because you're actually taxed as income. So the rates of the 20%, 40% and 45% would be payable on those. So again, if you want any more depth, either speak directly to the provider or speak to your advisor in relation to that. Let's have a look at some of the other ones. So we had one on business asset disposal relief was not abolished. So remember, it was formerly known as entrepreneurs relief, and we saw the limit decrease, but nothing was mentioned in the autumn statement with regard to that. So as far as we're aware, it still remains. So just mindful of that. CGT on selling old cars. So I'm assuming you're talking about classic cars, whoever had asked that question. So the rules around cars from an HMRC perspective is actually they're deemed to be what's known as something called a wasting asset. So that's an asset that would not really have a lifespan of 50 years or more. So if that's under 50 years, then on a sale of that car, it would usually be exempt from CGT in the same way as your own private vehicle. So again, if you're unsure, seek some advice, but that's a general rule when it comes to cars.
Yeah. Also a couple of questions coming in on the chat here. So somebody has asked, is the residence nil rate band on top of the nil rate band or included within it? May have already answered that one now, but yes, it's on top of the nil rate band, but it's only available in certain cases. So it's only available if you have children and if you are leaving a home or a former home to children. And that gift to those children, actually it doesn't necessarily need to just be children, it's children or grandchildren, and there's a wide definition. So that definition of children for purposes of the residence nil rate band actually extends a bit further than the usual definition of children to stepchildren, as well as legitimate and adopted children, and in fact to foster children. So you have a wide definition, but the key is that it has to be left outright to those children, grandchildren, etc. It can't be left to a trust for them. If it's left to a sort of discretionary trust, then it won't work. And in addition to that, the residence nil rate band, as I mentioned just a second ago, will also be restricted or even lost altogether for high value estates. So that's estates that exceed £2 million. How long do regular gifts from excess income need to be evidenced to be eligible for inheritance tax exclusion? Well, HMRC generally treat accumulated income as capital after it's been accumulated or sitting in a bank account left to roll up for around 3 years. Not sure if that's what you mean. If you mean how do you actually record them, then there's a form that you can get hold of from your SJP partner or indeed online called an IHT 403, which includes quite a useful little schedule of income and expenditure. Now, what happens is the excess income exemption is given retrospectively post-death. So once death occurs, your executors have to prove to HMRC that any gifts that you've made in the 7-year period leading up to your death have been made out of surplus income. And the IHT 403, if you get that completed during lifetime, then that gives them some really good evidence to work with, because it there lists all your income, all your expenditure, shows exactly what your surplus is in every year, shows what you've gifted, and that way you can demonstrate that all your gifts made in that 7-year period are exempt within the normal exemption, out of income exemption. If you mean, there's lots of different possibilities with this one. If you mean how long do you have to be paying those gifts out of income for them to be normal? Well, in fact, it doesn't have to be necessarily long at all. It's all about the intention. So there has been case law, for example, where the exemption has been allowed where just one single gift was made. But that's because the lady in question died having made that gift and having documented her intention to make future gifts going forward. It was just that she didn't survive long enough to establish the pattern.
Someone asked about, this is based on, we'd say English tax law, but most of what we've said, obviously because rates of income tax are different, or the thresholds are different in Scotland. So everything we've talked about here is based on England.
Yeah, the rates of tax are broadly the same for investments, I think, aren't they? Yeah. And most of the tax planning that you can take advantage of is the same for England as it is for Scotland. It's just, as Niki said, the rates and threshold, the rates for earned income and the income tax thresholds may be slightly different. I don't have those to hand.
No.
Okay, can you explain what you mean by advancing dividend payments and advancing corporate profit? Yeah, so all I'm talking about there is if you're planning to make if your business is planning to distribute dividends, or if your company is planning to maybe dispose of chargeable assets that are going to generate a profit, it may be worthwhile doing that sooner rather than later, so that you get the benefit of the lower rates of corporation tax and the higher dividend tax threshold and the higher additional tax threshold.
CGT implications of sale of property. Yeah, so obviously if you're UK resident and domicile, then you're in the scope of income tax CGT on your worldwide income and gains. So obviously if you sold a property overseas, then ordinarily you would be subject to CGT. There are double taxation agreements, in place, which effectively means that you wouldn't ordinarily pay tax twice on the same gain. You would basically need to look at the terms of the agreement, but you would report in line with your self-assessment, and then obviously there would be particular relief so that you're not paying in another country as well, dependent on the rules in wherever that property is located.
Another one here, do you have to notify HMRC if you gift money? Not necessarily. If you gift money away outright, that's what's called a potentially exempt transfer. So regardless of how much you give away, there's not going to be any immediate liability to inheritance tax. And in fact, there'll only be a liability to inheritance tax if you die within 7 years of having made your gift. So those kinds of gifts, and as well the sort of exempt gifts that Niki was talking about earlier, you don't have to notify HMRC if you make those type of gifts. Not at the time you make them anyway, but if you die, when you die, then your executors have to tell HMRC about all gifts that you've made within the 7-year period before your death, so that they can claim the appropriate exemptions. If you give money to a trust, then that's slightly different. In that situation, you will have to notify HMRC if the amount that you've gifted is more than roughly 80% of your nil rate band. And then there's a special form that needs to be completed on which you notify HMRC about that gift. We also, of course, have to register trusts now if you create a trust with the trust registration system service, and provide some additional information there. So I think we've probably maybe got about time for about one more question, Niki, and then that will bring us to the end of the webinar, and we'll try and answer some of the others over the next few weeks. I mean, let me take this one. For an integral attached annex that's part of a main residence, is capital gains tax payable when the house and annex are sold together, if the annex has been rented to a non-family member? Possibly, yes. So the way that it would work in that situation is because part of that property that you're selling only would be eligible for the main residence exemption. So what you would have to essentially do is speak to a tax advisor so that you can apportion your gain between the bit that qualifies for main residence exemption and the bit that doesn't. And you would then pay CGT on the proportion of the gain attributable to the annex. But of course, you'd have your CGT annual exempt amount to offset against that. So I think that brings us to the end. That brings us to 1:30, which is the end, the finish time of this seminar. So thank you so much, everybody, for joining and listening to us. As I said, we will try and get some of these answers, these questions answered over the next couple of weeks. The other option for you, of course, is to go and speak to your St James's Place partner who has access to our department and can put those questions to us and then feed the answers back to you. Thank you, everybody, for listening and joining.
Thank you.